So in previous chapters, we learned to account for the sale of merchandise using a perpetual inventory system. And when we did that, we recorded the sale by debiting accounts receivable and crediting sales for the sales price of the goods. And we accounted for the movement of inventory by debiting cost of merchandise sold and crediting merchandise inventory. With the perpetual, remember, we are constantly updating our inventory as we sell it. Then we spent an entire chapter on the second journal entry discussing how we account for the cost of the inventory sold. Remember, we used either FIFO, LIFO, or weighted average, and that amount, depending on what method we use, that amount would be different. So in this chapter, we're going to focus on the top portion of this journal entry. How to account for accounts receivable. If we sell on credit, that is, we don't require payment up front, we will inevitably have some bad debt expense. So we're going to learn how to account for that. This video is going to provide you with an overview so you will know what to expect when you look at the PowerPoint. So here's the overview, something to keep in mind when we're going over all this and where it's headed. So there's going to be two methods that we're going to discuss in order to account for bad debt expense. The first method is going to be the direct write-off method, and the second method is going to be the allowance method. The direct write-off method is used by smaller companies. It's not in compliance with GAAP. But that's okay because non-publicly traded companies don't have to comply with GAAP. So they can use the direct write-off method. The second method, which is in compliance with GAAP and it does follow the matching principle, is called the allowance method. Under the allowance method, we're going to be estimating our bad debts. And we'll have two methods to estimate our bad debt expense, and those two methods are the percent of sales method and the aging of receivables method. So those are two of the ways we're going to look at estimating bad debt expense. And whichever method we're asked to do will change the way we do it a little bit. So you have to know which method we're going to be doing, and we'll be doing both in this chapter. Alright, some of the important accounts we're going to use are the receivables. So it could be any type of receivable. It could be accounts receivable, note receivable, interest receivable, but these are all what we call an asset because it's our right to receive that value, an asset, which is usually cash. And the normal balance of an asset, any asset, is a debit, and assets are found on the balance sheet. Another important account is the bad debt expense, which is an expense, and the normal balance is a debit, and the financial statement would be the income statement. And then a brand new account called the Allowance for Doubtful account. And this account is going to be a contra asset account. And since this is a contra asset account and assets have a normal debit balance, this account would have a normal credit balance. And it would be found on the balance sheet right underneath accounts receivable. So this is how it would work. If a customer owes $500,000 and we set up an allowance account, which we'll learn how to do for $30,000. So the way we would look at this is we would take our accounts receivable and net it with our allowance for doubtful accounts to come up with the net realizable value of our receivables, what we expect to collect from our receivables. So that would be your 500,000 minus your 30. So the net realizable value of the accounts receivable would be $470,000. And that is because our receivable netted with our contra account gives you the net realizable value. So you'll need to read your chapter, look at the PowerPoint, and watch my other video that goes into more detail. And then let me know. You should be able to work the homework after that, and let me know if you have any questions.